folks. Best ever conference. Woo! Woo! That energy I'm getting from you sounds like you partied until about 1 a.m. last night. Is that right? 2? All right. Some folks have got me beat. You guys, this is a party hard crowd for sure. Is that right? Well, I'm still impressed you guys made it in the seats here at 9 o'clock this morning on a Friday nonetheless, and on the last day of the Best Ever Conference. So I want to say thank you to all of you for spending the last 2 days with us here in Salt Lake City and here at the conference. And can I get a whoop whoop if you learned something in the past 2 days? Whoop whoop! All right. That didn't sound like you guys learned that much. So, maybe we'll fix that with the last stage of the pitch slam this morning, which is coming right up. And I was talking to Matt Burke and his team at Verivest and Fairway America. They came up with this title, Pitch Slam. And I said, Matt, how did you come up with the name Pitch Slam? He said, well, we're going to let them pitch, and then we're going to freaking slam them with questions. Really tough questions. I thought that was pretty clever, and also I made that one up, so sorry for that, Matt. But we're so excited to have this group of contestants back this morning. These are the people who have made it through the first round. They've made it through some tough questions. They're going to get back up here, have 3 minutes to pitch with us this morning, and then just 6 minutes of questions, unadulterated, getting peppered by these judges who are putting their own money at stake. So it is high stakes now. This is do or die for all of these people. And we're incredibly excited to be back and in doing $600,000 in prize investment for these folks. So, can I please welcome Matt Burke to the stage?
Thanks, Garrett. Thank you. Okay, welcome. Here we are at the finals. We started this almost just about the time we finished coming to last year's thing. We put it out there. We had 90 plus applicants that Kellen screened through to end up with 12 that we thought represented a good mix of funds, syndications, different asset types, strategies, geographic locations, and so forth. Tried to bring the best 12 that we possibly could. You've seen them all present now. We've narrowed it down to 4. So congratulations to the 4 finalists, and you'll get the chance to see them here and listen to the judges ask some really tough questions. So judges, why don't you come on up, and we'll get started.
Thank you. I know that guy.
Okay.
All right, we're down a judge today, so we started with 5, went to 6, and we're back down to 5 here today. But we will have a total grand prize of $400,000 for the winner, $200 for the second place winner, and that will be all subject to due diligence, which will take place after the event. So without further ado, let's get started this morning and welcome our 4 finalists. We'll start this morning with Vali Lazarescu from thought I had that in my head, but I don't. Group RMC. Valley, come on up.
Good morning, everyone. I want to begin by where we left off yesterday. You asked me, Joe, you asked me a very existential question. Why are you here? So you had me in my feelings last night. I took the bottle of whiskey to my room, called my mom, called my girlfriend, called my shrink. And no, in all seriousness, I think you do have to start with why, right? Simon Sinek, he wrote his book called Start With Why, and if you can figure out your why, you'll be successful. So let me tell you a little bit about myself. I'll go into the slides later. I think you guys have questions, but why do I do what I do? A little background about myself. I was born in a communist dictatorship in Romania in 1987. After the Berlin Wall fell, my parents immigrated to Canada. We settled there, 2 young kids, myself and my brother. They raised us, and then whatever they had left over, they invested in their retirement accounts. They had saved up a few $100,000, and I remember one day specifically, my dad was very unsatisfied with his returns. The mutual fund company was charging him 3% fees and consistently underperforming the market. And so he called the portfolio manager, he called the company asking to be, just to get some information on what's going on. And they basically dismissed him. They said, yeah, you're not $1 million client yet, so if you're not happy, you can just leave. And that really pissed me off. So I told myself, if one day I'm in the position to have my own clients, my own investors, I'm going to treat them with respect and dignity and allow them to have access to me for information and anything else. So that's my commitment that I'm going to make to you, and that's my reason why I'm here. Yes, I do have clients that give us millions of dollars. We do have institutional deals, billions of dollars under management. But more importantly to me, I have clients, LFI investors, doctors, dentists, business owners that invest $30,000, $50,000 in our funds. And that to me is more important because it allows them to have access to institutional deals that they would otherwise not be able to access. And that is my why. So hopefully that answers the question. So now let's go into some of the investments. I had mentioned yesterday, we do ground leases. Our investors can access them directly. So each new deal, direct co-investments with us, no management fee, no performance fee, no carry fee, really a co-investment structure. Separately managed accounts for larger clients, and then we created a fund structure from the demand of our investors that you can just buy into once and invest in every new asset that we have. In terms of returns, this is the safest in the capital structure, the ground lease. Even banks are subordinate to us. We're targeting an IPO in 7 years, multiple 3.86 and 21.3 IRRs. Cash flowing day one, no development risk, and more importantly, safest position in the capital stack.
Thank you, Valley. Judges, questions?
What's the cash on cash each year projection, not including the sale?
The cash on cash is probably closer to about 14%. Part of that is the income, and part of it is the appreciation of the land. So one thing that I did mention yesterday, the Vatican deal that we did, Lower Manhattan Financial District, we bought the land for $350 a square foot. This is land in Manhattan with an existing structure that is cash flowing. We visited just a few days ago here in Salt Lake. They're building at $450 a square foot. We bought the entire thing for $350 a square foot. So not only do you have the income component of your investment, but you have the appreciation of the land. So cash on cash, depending on the deal, I would say it's 12 to 14%.
I guess for what we would be investing in year one, what would the cash on cash return be?
So now it depends. If you invest directly into an asset, that will vary. We have multiple deals going on, right? If you invest into the fund, that fund allocates to every new deal that we do. So that will vary. So year one, you can expect about like I said, a 12 to 14%.
Let's say in the fund, because that's probably the most likely vehicle that's readily available. So you're not getting cash on cash isn't included in the appreciation of the land, right? There's no cash associated with that.
Correct.
So, and my recollection from yesterday, you're buying them all cash.
Correct.
So there's no financing. So based on the price you're getting, then the lease to whoever the building owner is, that's the income.
Correct.
To you.
Yes, and there's a combination between royalty, which is just the ground, and a mortgage as well. So some deals have the mortgage, which is, right now trading 10 to 15, and then you have the ground lease as well. That's 5 to 7. So a blended yield, I would say between 12 and 14.
So with the ground lease being 5 to 7%, you also mentioned year-over-year escalations. What are those escalations?
So the escalations, that's very important. So every year, it's a structural escalation based on CPI. So let's say you start at 5%. Next year, you'll go up based on inflation. So if it's 3%, you'll be going up. So every year, you're getting these escalators, which is why our exit, these large institutions are coming to us and saying, we like the fact that you have these escalators built in. We have long-term liabilities if you're an insurance company. And instead of buying a treasury that might be down in 2 years to 2%, we'd rather buy these escalating payments that go up every year.
So are you also the lender on that piece as well for buying the property?
We could be. Depends on the deal. Some deals is a pure royalty, just the ground. Some deals we do provide a mortgage because banks don't like to be subordinate to us.
Right. That was
so
going to
be finance.
That's going to be another question too, is about the exit strategy. Because if you're trying to sell it to somebody else on the other end of this, Are you trying to maintain the ground lease and then just sell the building? Or are you trying to sell both the ground lease and the building at the same time? And then if you are, what kind of lenders are out there that are lending to somebody who has the building but not the land?
No, so when I say sell, we're selling the cash flows. We're selling the land and the mortgage to a third party, either a bank, an insurance company, an institutional investor.
So it's basically
Buying
they're
cash
going to be buying it all cash as well. Not really.
It depends on them, right? If they want to put 50% debt, or that's the buyer.
When you're buying it, though, are you buying you're buying into an existing lease already, or you're buying the entire land and building, and then you're selling just the building, and then you're executing a brand new lease?
No, we're structuring the entire thing from the beginning. So
Okay.
when we structure the deal, the moment the money comes into the fund, it's immediately allocated to a deal that's cash flowing from day one.
But when you're buying the building, you're buying the land and the building all at one time.
We don't buy the building.
Yeah, that's my
Somebody
question.
else-
So like you're buying just the land,
Land. Somebody else owns the building on top.
correct?
Paying
But,
us
but
a
so
royalty.
so that would mean there's already a lease in place with some seller of the land. Is that correct?
No.
So how does that? I'm confused. How
So
does?
when you buy a deal, you have a building and you have the land.
Yeah,
What
I
we're doing right now is we're buying strictly the land, and the operator or the developer owns the building. In exchange for operating on our land, he pays us a royalty. Now, he might need a mortgage as well, right? So that's where we can provide a mortgage at 10 to 14, and he also pays us on the royalty for using our piece of land. But they own the building, so there's no capex on our end. They're improving the asset, they're developing it at zero cost to us, and we benefit from all those improvements because we own the land.
And what kind of leverage is there on that mortgage?
So typically, we ask for a lot of equity. We'll ask for at least 40% of equity.
Okay.
We'll provide the debt.
Did I hear you correctly in that there's an IPO scheduled for 7 years?
Yes.
So for people that invest, it behooves them to stay in for the 7 years.
So IPO publicly, we can also sell it privately. A lot of our deals we've done privately. But if there's the option to list it on the market, then you can exit, just sell your shares in the open market, and you cash out.
Got it.
Just to triple confirm, so it's projected the fund to be 14% cash on cash return year one. So we invest, and it's year one, it's supposed to be about
Correct.
14%. And what about year 2, 3, 4, 5, 6?
It escalates. So
Escalates. So
yeah.
starts at
every year you're getting-
14%.
Correct. Every year you're escalating by a minimum of 2% up to 5%, depending on the inflation that year. But, so these are development type returns without the development risk, without default risk, and cash flowing day one. And that's what I think differentiates us.
Whoa.
And secondly, the access to these large institutional deals that you just can't get on your own. So that's my pitch.
Thanks, Vali. Nice job. Okay, very interesting. All right, help me welcome our second presenter. We have Vanessa Peters and Maurice Johnson from Rockstar Capital.
Good morning.
Morning.
Good morning, everybody. For those of you who weren't here yesterday, my name is Dr. Vanessa Peters, and I'm a general partner with Rockstar Capital Development Group. And we have unlocked the secret to cash flowing on land. Affordable single-family homes are in desperately short supply, and we're helping to solve this by focusing on the process of land entitlement, which is one of the big bottlenecks to home builders trying to ramp up housing. Rockstar Capital Group is a private lending fund, and we lend to our strategic partner, BRD Land and Investments. Our team is here on this slide. Today I have Mo Johnson here with me. Once the land is fully permitted, BRDL focuses on land entitlement only, and they sell to their home builders, D.R. Horton, Lenner, Meritage, etc. They don't do any infrastructure, no horizontal, no vertical construction, and this is a huge value-add proposition. It can add basically double the value of the land in 9 to 24 months. And in an ideal transaction, the land purchase agreement allows for control of the land until it is shovel-ready. Then it is purchased from the seller and sold to the builder in a simultaneous close. We lend at 25 to 30% annual interest and provide 90% of BRD's funding needs. These are primarily pursuit costs and due diligence. We can charge these high interest rates because of our strong relationship with BRD, and we provide a very convenient process for a small loan against the project. And it's worth a premium to them. With their 40% profit margins, the net interest paid is typically 2 to 5% of the profit. Rockstar Capital Group is our fifth fund, started in January 2023. It's a Reg A offering, quarterly distributions that start immediately, with low management fees of 1.5%, liquidity after a 12-month lockup, and 10% preferred return and 60% profit sharing. We have a minimum of 10K with 1,000 increments thereafter. And annual audited financials are added peace of mind. We showed this yesterday, just an actual deal for illustration. Note for $500K on a piece of land worth $6 million, and upon sale, $225K in interest paid back. 64% of the profit goes to the LPs. Our unique selling proposition is our focus on land entitlements. Our competitors are doing small projects or including horizontal and vertical construction. BRD's strong connections through their team and with the corporate leadership of the home builders is their secret sauce. BRD and Rockstar are helping to solve the huge deficit of affordable single-family homes nationwide. And they're on track to scale to 20,000 paper lots sold annually in the next 3 years, which would be $200 million in gross profit. This assures an ongoing need for short-term funding from Rockstar. I'm excited to have you participate in our conservative offering that provides steady, passive cash flow, especially during a time when other asset classes are holding distributions and looking at lower than anticipated IRRs or equity multiples. Thank you for your time, and we're happy to answer any questions.
Thank you. Questions from the judges?
Did I hear it correctly? 64% of the profits go to the LPs?
In that particular example, I broke it down, yeah.
Where does the, excuse me, where does the rest of it go?
To the GPs.
Okay.
And fees, of course.
Can you remind us of the fee structure on the fund?
So it's 1.5% fees.
That 1.5%, that's a fund management fee.
Correct. A flat fee on the amount
And
that's in the fund.
And there's a pref,
10% pref,
and then it's a split.
60-40, 60 to the LPs.
How often is that split calculated?
Quarterly. So whenever there's a profit sharing event, which has been every quarter for the past year, then that's when the split occurs.
The pref, if you don't hit the pref, then what?
So we have paid out the full
catch
pref.
up?
Well, we have paid out the full pref, but yes, there would be a catch up if we couldn't pay the full pref.
Before you get the 40, right?
Absolutely. Mm-hmm.
What percentage of your loans go to BRD?
All of them.
Okay. Is it a concern that all of your eggs are in one basket?
You could look at it that way, but we have such demand from BRD that we can't raise enough capital to keep up with them. And we're close strategic partners. We are approached by lots of people who would like us to land on that, but we are focused right now. We feel that this is a really good opportunity.
So just want to clarify a few things here. So what we're doing is with this particular fund is we're providing due diligence money on contracts that have not actually been closed yet. Is that correct? Am I following that?
Yes, that's correct.
Okay. And so yesterday I asked about the execution risk, right? And like what's the worst case scenario in a situation where you're lending money to BRD and what happens if they can't sell that land or the contract expires or something happens there, now you're stuck with a note that they can't sell the land. Has that scenario ever happened? And if so, like how does that actually play out?
Well, a couple things to that. First of all, you're right in terms of this is an offering for pursuit cost towards the acquisition of land. When we underwrite every deal, we underwrite it like we're home builders. When Vanessa mentioned the team is one of our secret sauce. We're all former home builders. You know, they're VPs of land, directors, division presidents, former CEOs of home builders. So we underwrite projects like home builders. And so when we initially sign a deal up, the initial due diligence is all around, does the deal work from a home building perspective? We've got multiple interests from different builders as we move forward with it. The land purchase contract is exactly what it sounds like. It's an option with our underlying sellers to monetize this and close once the entitlements are secured. We will, as it relates to the spend on a project, we are very slow and diligent with respect to it. And so in the event a project doesn't close with one builder, we have backups. And so it's not really a concern as to whether or not we're going to have a project that we can't sell. It's a timing, the time could be the component. And so as it relates to the lenders on this project, in terms of these suit costs, there's value with the dollars that we spend, whether it be the engineering, whether it be the soils testing, so on and so forth. So in the event a project, let's say, doesn't work, we can monetize the proprietary information that we do on the diligence that we do on the project. So even from a downside perspective, somebody that's going to come in and buy that project is still going to need the work that we've
And how often does that happen?
probably from a BRD perspective, in our life cycle, the company's we're in our 5th year of operations twice.
Out of how many deals?
Right now, we have 80 deals that we're working. We've closed 12 deals, company to date.
Okay.
We have a pipeline of $1 billion of paper lot revenues currently today.
So roughly 20% of the closed deals.
Of the closed deals, yes, but of the pipeline, significantly less.
What percentage of the hard costs is being funded by Rockstar? 100%, or does BRD put some of that in there itself?
Yeah, BRD definitely puts some of that. The percentage is typically, it's typically somewhere like 2 to 1 as it relates, about 66% from a promissory note perspective. The rest is coming from equity from BRD.
So with your relationship, if you decided to no longer work with Rockstar, where does that leave you?
Where does that leave Rockstar?
Yeah.
Well, we would probably need to find someone else to lend to, or we would wind up the fund and return capital.
Is there any personal guarantees from BRD?
Yes, with the general partners.
Okay.
45 seconds here. Any other questions from the judges?
Any preferential positions in the capital stack for us if we choose you as a winner?
We don't have any preferential treatment at this time. When we went from the last 506C fund was an 8% pref, and we did have one of those, if you put in $1 million, you could get 10%. But then with this Reg A fund, we simplified it and have just one class of investor at 10% pref.
How much does a Rockstar team have in the fund?
2.5 million.
Of the, how much total equity? 40 something?
46.
46.
Mm-hmm.
Okay, thank you very much.
Thank you.
Thanks, Vanessa. Thank you. Thanks, Maurice. Okay, 2 down, 2 to go. Please help me welcome Zach Alms from 507 Capital. Zach.
Judges, thank you for having me back up here. It's truly an honor to be on stage with you and these other sponsors. All right, I got a question. When was the last time any of you ordered a haircut online or had a virtual chiropractor or dentist appointment? Or maybe you ordered a cup of Starbucks from Amazon? Well, I'm guessing you haven't done any of those, but what you may have done is gone down the street to the local strip mall and gotten any one of those services. Those are the kind of buildings that we buy. So retail vacancy currently is at an all-time low. So it's an amazing asset class to be in. All the tenants we have are on triple net leases, which means that we can bill back property taxes, property insurance, and common area maintenance expenses. Because of those triple net leases, we have a very risk-averse, predictable income with consistent cash flow for the long lease terms. I also said the other day that I started this company so that others could join in on my investment journey and to give back to the communities we are investing in. That wasn't just a line. I honestly want to help people invest in retail real estate that lack the time, the knowledge, or the expertise in this asset class. And when I say I want to give back to the communities, I mean that we donate 25% of our annual profits out of our asset management fee back into these communities. All right, we'll go into the fund now. So this is a 506C offering. We're raising $10 million to go out and acquire 6 to 10 strip malls across the Midwest. We'll have 2 share classes. We'll have the A1 share class at a 6 pref, A2 share at a $500,000 minimum for the 7.5 pref. Following the pref, we'll have a 70-30 split, and then that'll be flipped upon a 2x multiple. Fees are pretty low, 1.5% acquisition and disposition fee, and then a 2% asset management fee. We will have a 3 to 7 year timeline on this fund. Projected IRR will be 12 to 18%, and a projected equity multiple of 1.75 to 2.25. We do already have 2 properties under a contract to get this fund going. We have a Starbucks center, strip mall, and then a Walmart out parcel. Both are in high traffic areas, good retail corridors. They have long-term leases in place and obviously good tenants in place, and they'll be cash flowing from day one. Looks like I got extra time, so a little bit about me. I am the founder of 507 Capital. Started a couple years ago. I have over 14 years of active real estate investing experience. I've been in retail for 5 years. Prior to that, I started in multifamily, and yeah, let's answer some questions.
Okay, judges, questions.
You had mentioned you do a mix of large national companies and retail. Do you have a target for having an anchor national company, or what's your goal of kind of occupancy?
Yep, that's a good question. So we're Class A strip centers. There'll be value add deals, a couple value add deals, but mostly stabilized. Your question is, what kind of tenant mix are we looking for? We try and have at least one credit tenant, meaning like a Starbucks or an Aspen Dental, a Chipotle, one of those national brands that you know. We want to have something in the building that kind of drives traffic to the center. You might get traffic coming to the hair salon or the nail salon, but a Starbucks will drive the traffic a little bit better.
On that point, who are the neighbors to that Starbucks?
The Aspen Dental, and then it's an urgent care operator in the Midwest, U-Care. So.
And the other property, can you give us the list of tenants that are there?
Sure. Qdoba, Aspen Dental again, Jimmy John's, Little Caesars, Miracle Ear, a barber, a nail salon, massage. I might be missing one.
When it comes to tenants, are there any tenants that you would not want in a facility, for example, a vape shop or something like that might reduce the value of that area or that particular property?
It's kind of fluid. You try and have the good tenant mix for the location within that market. But with that being said, I don't really want any tattoo parlors. I'm trying to stay away from dispensaries, and there's maybe a couple. The ones that bring the wrong clientele. It's kind of obvious not to have those tenants in there.
They're identified acquisitions. So does that mean you're just waiting on the money and then you sign a contract, or
so they're
what's happening?
Already under contract, but we're not closing on them for another 60 days or so. So we already have $1 million raised for our $10 million fund, and so the goal is to have, the next. I think we need $3 million to acquire these properties in the next 60 days, and then we'll continue to raise until the end of Q3. And then we'll shut it down.
Are 100% of the tenants triple net, or do you have any gross or modified gross?
They're all of these ones are on triple net. There is a value add component to taking a gross lease to a triple net lease, but we don't have any gross leases right now. They are on all true triple net leases.
Is the debt already secured for these two?
We're in the works of. I've gotten a lot of term sheets. We're actually working on the Starbucks one. We're going out to a life co to try and get some terms, but we don't have them secured. Well, one of them we do have secured. It's going to be. I'm having a mind blank, but we're going to be able to. I can't think of the word. I'm sorry. Yes, we have debt secured on one of them at a low interest rate, because I can't think of the word. Well, geez.
What's the LTV that you're targeting for?
65 to 75% LTV. And back to your question on the debt, we also sign out, these are all full recourse loans, unless we go with the life co, but that's still be partial recourse. So the investors are only at risk of what they invest, but me and my partners are at risk for the whole amount of the debt terms.
How many full recourse loans are you signed on?
5 currently, because I have a portfolio outside of this as well. Yeah, 5 currently, and we'll be signing on more. Yep.
And as an LP, it's a pro and a con, right? Pro, alignment of interest. Con, something goes wrong. You have a lot of exposure across those 5 other properties. Knock on wood. How do you reconcile that?
Very conservative underwriting, long-term leases. If something went wrong, or that's worst case scenario, every tenant left every building, well, I would be up Schitt's Creek. And, luckily you guys are only invested for a small portion, and I'm screwed, so yeah.
What locations do you, where are these two? Maybe I missed that. And like generally speaking, where are you targeting?
They're in secondary, tertiary markets. Both those are in Minnesota, one in Duluth, Minnesota, and the other in Winona, Minnesota, both with good, they're both in college towns, good growth in those markets.
What's the co-investment from the 507 group in these deals or in this fund?
We are in for at least 5%, which would be equal to about $500,000. It might grow to more as we go.
And is there another party that's signed onto these full recourse loans, or is it just you?
Me and my partners, my other GP partners, they will also co-sign on these.
Are they being cross-collateralized with the other assets?
No, we don't cross-collateralize anything.
How much capital have you raised, either you or your team together, prior to forming? Was it in 2022 you guys joined together?
So yeah, we started 507 Capital in 2022. We raised $1 million last year, and then we're trying to 10x that this year with a $10 million raise. We already have a million committed to this fund, and did I answer your question?
So this is the first capital raising you've done?
No, we did one last year.
But prior to this, is this kind of in the last couple of years your first time raising capital, you and your team?
Prior to last year's raise, we had never raised capital. We had done some JV deals, but had accrued about a $15 million portfolio of retail strip centers with private money prior to raising capital. Yes.
Well done, thanks, Zach. All right, 3 down. Last but not least, please help me welcome Clint Harris, Nomad Capital.
Good morning. Good morning. So yeah, I'm Clint Harris with Nomad Capital. So we're a heavy value add self-storage syndication. We specialize in conversions of big box retail buildings, grocery stores, old mills, and Kmarts into climate controlled self-storage in secondary and tertiary markets across the Southeast. So we're pitching El Fondo. The returns on this are a 19 to 22% IRR. It's a 10-year hold, 3.2 to 3.6x equity multiplier with an expected return of capital around year 5 by way of a cash out refi. We're currently a little over 40% subscribed. We have 2 closed properties in the fund and just had an accepted offer on the 3rd while we're here at the conference. So across our conversion portfolio, on the day that we're standing out front and we're cutting that ribbon and we're opening up the door to rent units, we're average $64 a square foot for the cost of the purchase of the building, the land, the construction, the parking lot, all of it. So about half the cost of traditional ground up development. Because of the low cost basis, once we hit stabilization, we're typically sitting at around 35% LTV, which means we don't have to liquidate the asset for our investors to get a payday. So we offer pref, cash flow, and then at or before year 5, refinance, return of capital plus another cash event. That cash event coming on top is obviously non-taxable as a refinance, then continued cash flow. The biggest thing for us is that we leave our investors in the deal, and we want to hold it for the long term. So on this fund, we have 3 share classes. It's a $50,000 minimum Class B with a 6 pref, a $250,000 Class A with an 8 pref, and $1 million Class A plus with an 8 pref and a 5% equity bonus on top of that. So we're targeting a 19 to 22% IRR and a 10-year hold, 3.2 to 3.6 equity multiplier. This is El Fondo. It's a $10 million fund for the purchase of $30 million worth of buildings that are going to be converted to $75 to $80 million in self-storage. And this is the team. These are the faces that make it happen. Full vertical integration. We find the buildings ourselves on, but mostly off market. We raise the capital in-house, construction in-house, management in-house as well. Like, look, there's nothing that sexy about self-storage, right? You're renting someone a box of air. What is sexy is when you take some of these old buildings that have been empty for 10, 12, 15 years in these small secondary, tertiary markets that have great visibility and great residential density in a 1, 3, 5, and 7 mile radius. We're not buying them on a cap rate. They're basically worth what we're willing to pay for them. We convert it to a different asset class. It creates massive forced depreciation in the property, which means we can refi to pay our investors, leave everyone in the deal, and create truly passive income that continues to carry on beyond the terms of the current fund. That's all I have for you. I'm happy to answer some questions.
Questions?
How many of these deals have you taken full cycle?
It's a great question. So for us, full cycle means executing the business plan, right? We don't want to sell the golden geese, right? We'd rather keep the eggs. So 4 properties that Eric bootstrapped as proof of concept leading up to this that have gone full cycle with the massive forced appreciation, either expansion or conversion of warehouses, refinance, recapitalize, cash on top. As a syndication, we started in 2021. We bought a Kmart and did it as a proof of concept. And obviously those projects haven't hit the 5-year mark yet. So obviously we're hoping we're going to be in much better mortgage rate terms when that comes around. So we're looking forward to a couple exciting years ahead. But 4 projects that have gone full cycle outside of the fund as proof of concept, none inside the current syndication.
What are your locations geographically? Where are you targeting?
So we're across the Southeast. We're based in Wilmington, North Carolina, but North and South Carolina, Virginia, Tennessee, and Georgia. So we're out of Florida. Insurance is too high. We just had the LOI that was just accepted as our first property in South Carolina, which is my home state, so I was excited about that. But yeah, Southeast specifically focused on secondary and tertiary markets. Like you won't find us in a Charlotte or a Raleigh, but you'll find us in a Gastonia 15 miles outside of Charlotte, because what we're seeing from a feasibility standpoint is massive population growth that's getting pushed out of the urban areas into these smaller suburban markets that are traditionally underserved for housing and especially for storage. So we go into markets that they have an underserved demand right now, so we're not speculating on that. And we really like those markets, especially because the younger people getting pushed into those markets are renters, and renters traditionally use more storage. So right now, the millennial population makes up 34% of the population in the country, and they utilize 38% of the storage. And in our market, instead of renting a 2-bedroom condo for $1,800 a month, they're going to rent a 1-bedroom condo for $1,300 a month and then get a storage unit for $150 or $200 a month. They still use the unit, but they're using it differently. They're using it as an extension of the closet, extension of the garage. They still have items like, they're using it for winter clothes and bikes and snowboards and fishing rods and waders. So the way they're using it is totally different. The consumer has changed. So the traditional consumer was in there once or twice a year for Christmas decorations or whatever. These consumers are in there once or twice a month, if not once or twice a week. So if you're doing storage right now, it needs to be several things. It needs to be safe, secure, well lit, easy access, and it needs to be climate controlled, and that's all that we do.
When does the cash flow start?
So we're saying end of year 2, beginning of year 3. This is a quasi-development deal, right? So it takes us on average about 12 months, depending on the size of the project, from acquisition to the time that we're opening up the doors. So about 12 months for construction, about 12 months for lease up. Average self-storage is break even around 60 to 65% occupancy. Ours is at 40. So we offer backhoe pref for the first 2 years. So we're saying cash flow starts end of year 2, beginning of year 3, keeping in mind that this fund is already started and the first project is scheduled to open in the August-September timeframe.
What do you consider stabilization?
So stabilization industry-wide is typically like 85%. We're underwriting for around 90. Our portfolio, the properties that we've held long-term are occupied above 97%, but we're underwriting around 90% occupancy. When we go into a market, we're looking at the average price per net rentable square foot for the climate controlled in that market, and then we shave 15% off of that number, and that's what we use for our underwriting. But stabilization for us is above 90%, around 92 is what we're underwriting.
How long does it take you to get to stabilization?
Great question. Completely depends on the size of the facility. So we have 40,000 square foot facilities and we have 97,000 square foot facilities. So obviously during construction, we're starting a marketing campaign with the idea of the day that we're opening up the doors, we have a wait list. Smaller facilities are going to book up fast. Larger facilities are going to take longer. The feasibility study of the market, third-party feasibility as well as in-house, dictates what the unit mix is going to be. So obviously, if you have a lot more, like we've got 2 Kmarts, one has 550 units, another one has 750 units. But it's because that market dictates a lot of smaller units, which is great because it's a higher price per square foot.
So you obviously have some other assets in your portfolio, though. So what's the ballpark, like, average in your portfolio of how long it takes to get to stabilization?
Most of our properties that we've done as syndication, year of construction, are still at lease up. So 24 months, 18 to 24 months, some a little bit longer if it's a larger facility. But it's cash flow positive at 40%. So that's when we hit 40% occupancy, we build up a small interest reserve to make sure that once we start distributions, we don't have to stop them, which we've never done, and then that starts. But to completely lease up all the way to what we consider stabilization, 18 to 24 months.
And at what point in time are you trying to get the refinance in place?
So we say at or before 5 years. Obviously, if the property's doing great and it's rocking and it's stabilized, there's no reason to wait 5 years. So we're gonna look at the market and see what the interest rates are doing. So at or before 5 years, there's so much equity in these properties that we can refinance when we need to without stressing the asset. We're gonna refinance to 55, maybe 60% LTV. We don't wanna stress the asset, but at or before 5 years is what we're saying.
Are you waiting till your development's 100% done before you're starting to lease units, or are you doing this in stages?
Typically, so it depends on the market. If we could get a partial CO, we will. Usually we have to wait until it's done, but that's why we're leaning into heavy marketing and trying to get that wait list built up, have a ribbon cutting ceremony with the Chamber of Commerce, open the doors. Everybody in that town typically knows where the old Kmart building is. It's got great visibility and good traffic count, so big signs and, you know, the banners and the flags and all that. But a lot of times we have to wait for CO before we can get approval.
Thanks, bud. Thank you. Nice job. All right, that's it. Give a hand to everybody. Thank you. Thank you to all of our judges, too, for their participation, time, and effort and energy. So we've got some judging to do. We're going to go backstage. Promise you we don't have it already picked. This is actually happening live. We're going to go figure it out right now. So hang tight. We'll be back in maybe 15, 20 minutes, and we'll come back with our winners. So we'll see you here in a few. Thank you.
Thanks, Matt. Thanks, judges. One more time for our awesome judges, folks, please. Self-storage, land development, land leases, retail, they've got their work cut out for them, and they're going to be back there duking it out, figuring out where they want to put their own hard-earned money. And I don't know about you, if it was me and I was putting $100,000 in, I would need a lot more than 20 minutes, but we're only going to give them 20 minutes to make these decisions here. That's how much our judges are committed to this pitch slam and to finding the best operators that they can for this competition. So we will be right back here in 20 minutes, folks. Don't miss it. The grand finale. Who's winning $400,000, $200,000? We want to see it. And don't forget, BEC25.com. Yesterday, our first 100 tickets at $695 sold out in just a couple of hours. So we've opened up 100 more for you, but the price has gone up just a little bit. We'll be right back here in 20 minutes. Thanks, folks. See ya. Best ever conference, folks. Who's excited? Who's excited to see who's winning the pitch slam? Let's go, big round of applause. Come on, folks, who's excited? This is the moment we've been waiting for. We've been deliberating. We've been watching these contestants. We've been wondering who's gonna win this prize money. This is pretty significant for anybody who's raising capital at any size. We're so excited about this. And thank you so much for spending time with us at the Best Ever Conference. The conference is gonna be right back here in Salt Lake City in March of 2025. Yeah. Matt, please come on out here. Matt and the other judges have been deliberating, and, you know, talk about a pitch slam. They're slamming each other backstage trying to figure out, hey.
It's a brawl.
Yeah,
it's a brawl.
It's a brawl. Like, no, I like this play. Oh, I don't know about that asset class. It's a difficult decision, but you guys have made it, and you made it pretty darn quick, and you came strutting back down the escalators like you guys had just figured it all out. So I'm excited to see who's winning. I still have no clue.
It's a hard choice, all good presenters, all good options.
Yeah.
So, okay, well, thank you. As everybody knows how this works, right? It's like we get $400,000 for the winner, $200,000 for second place. All is still subject to due diligence. We've seen the presentations up here. We're going to do the deep dive afterwards. Encourage everybody else, if you're going to invest with any of the people that the judges select, please do your own due diligence as well. With that said, we're super excited to be able to award the prize to a couple of worthy recipients. So without further ado, I don't know, do we have a drum roll or anything like that?
Let's give us a big drum roll from the audience, please. Come on.
All right.
Big check here, $200,000.
Difficult choice, but our runner-up, number 2, is Zach Alms with 507 Capital. Say a word, Doug, Zach?
Thank you.
That's good. That's good. Okay, well, then wait till the
Zach,
second
we're
one.
going to have you step right over here to the side because
All right.
that's a big check, and you got to make sure you go to a big check bank for that. But
Yep.
we've got a bigger check coming.
It's not going to fit
just
in the
a second.
ATM. Okay, so we have 3 possibilities. Group RMC, we have Rockstar Capital, and we have Nomad Capital. Does anybody, I'm sure, have your favorites? But the judges had to make some very difficult decisions, which we did. So our winner today is Valley Lazarescu with Group RMC.
All right. $400,000. Judges, come on up here.
Judges, come on up.
Zach, get on out here. Thank you. What a group, what a competition, what a crowd. Thank you, judges. Thank you, contestants. Thank you, Best Ever Conference. Thank you, Salt Lake City. Couple good pictures up here. And that is our show, folks. Let's give it up one more time for all these great folks. Thanks to everyone who pitched. Thanks to everyone who came. Thank you for speaking. Thank you for sponsoring. We are so excited for this show. We will see you next year.